If you want to know for about 95% of how investing works, you need to know these three words. Okay, so the first word is stock. What is a stock? So a stock is a piece of ownership of a company. Let's say, for example, you have your own business and you're selling apples. One apple equals $1. Well, and you're generating revenue, you're making profit, and your business is growing. And you own 100% of that company. Maybe at some point you want to grow the company and you need more money. Then basically what you can do, you can sell a part of your company, a piece of the pie of the 100% that you yourself own, and you can sell it to somebody else. Let's say, for example, you want to sell about 10% of your company and you first have 100% of the company, which equals maybe 100 shares. You then are going to give away 10% of the shares or 10% of stocks, which equals 10 in this example, because you had 100 stocks or shares yourself and now you're giving away or you're selling 10%, so 10 stocks or shares to somebody else. And what this means is you're giving away a piece of ownership. That person will get 10% of ownership of the company, and in return you will get money for that. So we're not going into the technical details about that, but basically with this stock comes ownership. But this stock not only gives you ownership, it also gives you a right to the profit that your company is making, which is the second term we're going to talk about, and that is dividend. So let's go back to our Apple business. And in the first years of our business, we had 100% of the shares of the stocks, which means 100% of the profit was for us. And with that profit, we could do multiple things. The first thing we could do is just keep it inside of the business and do nothing with it. The second thing we could do is use the profit the business generated and reinvested it in the company, maybe by buying up multiple locations, by expanding the amount of apple trees that we want, by purchasing land. So that's the second thing we could do. And the third thing we could do is pay the profit to ourselves, 100% to the shareholders. So in this case, because you are alone in this business and own 100%, you are entitled to everything. But now let's say you have sold 10% of that 100% to somebody else. That person now will get also 10% of the profit that we're going to transfer into dividends. This is not always the case because a lot of companies don't decide to give out dividends. They prefer to keep the money inside of the company, to let it grow, to invest in new assets, in people, in research. But they might decide to later on pay a part of the profit out in dividends to shareholders. So yeah, we had stocks or shares as the first important word, then dividends, had the right to get a part of the profit that is generated by the company. And the third word is an ETF. Now, what is an ETF? An ETF is basically a bundle or basket of different stocks from different companies and different industries. So basically representing the different parts of the world with the different companies. For example, Apple shares or Meta shares from the US, but also European shares. Think, for example, about ASML in the Netherlands or maybe LVMH in France. These get all accumulated in an ETF, and then you can buy that ETF. And the big advantage of this ETF is that you're immediately investing into thousands of stocks across all over the world. So when there is a problem with one specific stock or industry, you won't feel that normally inside of an ETF because the risk is spread out across all these different industries and companies. What is important is that there are two types of ETFs. I just want to keep this simple. One is a distributed ETF and one is a accumulated ETF. The difference between these two is that a distributed ETF pays out dividends to the owner of that ETF. So you can see this a little bit as, okay, I own a stock of a single company and I'm also getting dividends. The same goes with these distributed ETFs. because inside of the ETFs are companies that are paying out dividends. Not all of them, but probably a lot of them are paying ETFs. The owner of the ETF, the company that has made the ETF, can decide whether they want to distribute those ETFs or accumulate them and keep them in the ETF themselves. So that's the second ETF you have, an accumulated ETF. So this ETF is not paying out the dividends of these companies, but is keeping them in the ETF. So normally, if you would have like two ETFs that are all world representing the same companies, the same stocks, and you would look at the value of these ETFs when they started both at zero, the one ETF that is not paying out any dividends normally will grow quicker than the one that is paying ETFs, because in the accumulated ETF, where there are no dividends, these dividends are reinvested back into the same companies inside that ETF, thus growing quicker. In the other case, where the dividends are paid out to the ETF holders or the shareholders, the cash is floating away to these holders, and then that value is basically lost if it's not being reinvested. All right, so these are the three words you need to know when you start investing. This will cover around 95% of the things you need to know when you invest. I hope this was helpful and gave you a clearer and better idea about investing and about stocks and dividends. I hope this gave you more of a clear idea of how the markets, how investing and finance works. Plenty more videos are coming about me explaining different words in investing, about why you should invest, what are the best things to do with your money. I hope this was helpful. Make sure to subscribe, hit the bell icon, like this video, and see you in the next one. Peace.